Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, welcome back to another episode of the Finance Garage. As always, Jonathan Wu here, Senior Financial Advisor and Principal at the SWU Group. And today, for the first time for the Finance Garage, we have an overseas guest in town from Hong Kong. We have Gordon Ip, who is the Chief Investment Officer of Fixed Income at Value Partners, which is a homegrown brand of asset manager based in Hong Kong. And Gordon manages locally here in Australia the Antipodes Asia Income Fund on behalf of Australian and New Zealand investors. And it's great that I've been traveling the week with Gordon, seeing our clients. Welcome, Gordon.
Thank you, Jonathan, for having me.
So, Gordon, you've got a very extensive background, in credit through your whole career, the US, and then, more recently for the last decade and a half in Hong Kong. I mean, post-COVID, China's gone through a pretty tumultuous economic, let's call it, set of economic circumstances. It's been tough. I mean, do you think we're past the worst of it?
Well, thank you for your question, Jonathan. I think to answer your question, right now I would say the worst time for the Chinese market slightly behind us, but it doesn't mean that we will have a bright sky really soon, to be very honest with you. The main issue right now remains is the property sector in China. As you understand, we have seen, as far as the credit investor is concerned, we have seen a lot of default in the China property sector because of the cram down exercise orchestrated by the Chinese government, right? Just want to put you in the context. If I ask you, what do you think is the accumulated default rate among Chinese credit issuers?
I mean, I know the answer to that, right? And I mean, I guess I think in any environment, if we had corporate defaults of probably, 10 to 20%, that's a pretty big crisis.
Yes.
Right?
Yes,
okay.
Yes.
So
in the case of China property is from the first default we've seen up to today, we are talking about over 90% default rate, right? Meaning 90% of the entire China property credit universe is already wiped out.
So for the benefit of our audience, what is the definition of a default?
Usually the most simple understanding is that, okay, whenever there's a payment due, whether it's the principal amount of the bond, or even though they miss a coupon, you can officially declare them as default, right? Basically missing a payment. So from that perspective, we are talking about over 90% of the universe already wiped out. So what's left behind is the remaining 10%, which are the names that are still performing in a way they're still servicing the debt. But right now, the most depressing situation is, as you understand, as a normal citizen of any country, the property sector is a very important sector because it has a strong relationship with other sector as well, right? Just put it simply, if you buy a house, a newlywed couple buy a house, they usually will buy associated stuff, right? Like buy a new car, buy new furniture, right? And all that. So the associate impact with a collapse of the property sector usually has a tremendous impact to the rest of the economy. Same thing for China, right? So right now, because of the price of the physical property have come down substantially, it has have a very negative impact on individuals' perceived wealth, meaning the wealth effect. All right. just very easy to understand. If your balance sheet, meaning your house,
Yep.
the house usually for most people is the most important investment for the whole life, right?
Yep.
People work for the whole life, have mortgage on to buy a house. Now, if that piece of asset has depreciated a lot in value, it's a very negative impact to one's perceived ability to spend, right? People would naturally save up and spend less, and that's exactly what we are observing right now in the Chinese society. Is that people, compared to the past, they are much less willing to spend, and that will basically have a drag on the GDP. Now, the good thing is the Chinese government finally realized that they really have to do something to revitalize the property market. But it's not going to happen overnight. It's going to take a period of several years, because we are facing a market with a lot of unsold home, right? To give you a perspective, inventory months, meaning the number of months needed to clear the entire inventory in the market, used to be something like 14 to 15 months.
Yep.
Right now we are talking about 30 months, which is double the amount of time that it used to be. So we really need to take off this excess inventory from the market, and it will help to stabilize property prices on the way. And that will in turn makes consumer feels better on their perceived wealth level, and that will again translate into better spending behavior going forward. So we're talking about, usually when the property market is talking about a price coming down, nobody wants to buy, to a next stage where price start to stabilize and people will negotiating to buy, but probably still at a lower price.
Yep.
To the third stage where the full recovery is finished. So we are talking about, we are somewhere between stage 2 and stage 3 in this cycle. So to answer your question, yes, I think the worst times probably behind us, and the market is embarking on a journey of recovery, although slow, but I think there are better things to expect down the road.
I mean, ultimately, you might have government successfully destocking the property market, right? And as you said, you need the buyers to come back in and meet the sellers, right, to create transaction volume. Is there, in your opinion, do you think there is any long-lasting impact? I mean, the government was clearly aiming to change the psyche of the Chinese population and not to sink all your eggs in one basket being property, right? Because that was clearly the easy way to grow your wealth for probably the better part of 30 years,
Correct.
right? Since the opening up of the Chinese economy. Do you think that what we've gone through has fundamentally changed the psychology, and it has led to, whether it be you're a high net worth investor or you're middle or upper middle class looking for investment opportunities, start to think, well, probably I shouldn't just do everything in property?
Yeah, I mean, if you follow the Chinese market long enough, you realize for the people inside China, there hasn't really been a lot of investment option for the general public to invest, right? So therefore, historically speaking, and also because of the unique Chinese culture, Chinese people like to buy bricks and mortar. This is something that they can perceive, they can touch, they know where it is. So buying a property has always been a major sort of lifetime milestone for a lot of Chinese. I think what we have seen right now is that, okay, right now we're talking about people, there's only 3 investment instruments in China, right? Property, number 1. Number 2 is the stock market, meaning the A-shares market, or you just simply leave your money in the bank, right? So I think this lesson has taught the general public and also the government that they really need to broaden out the investment choices for the general public, so that not every single dollar money is being invested in property, right? Ultimately, I think the Xi Jinping's government's goal for houses in China is for the living, is not for speculating, which is a right thinking, right? So I think going forward, I think we will see a broadening of the investment universe for the Chinese people in the future.
If we sort of turn, and pivot the conversation towards credit, which is, what you specialize in, I mean, we see a lot of ability to invest in bonds in Australia. It's a market, broadly bonds is a larger market than equities, so debt's larger than the share market. How do you feel the Asian credit markets in a broad sense differ from Western bond markets?
I think for the Asian market, just put things in perspective, right? If you reference the index in terms of size, the entire Asian credit market is about $1 trillion, which is roughly the size of US high yield market, around the same size. I think a little bit different is that in Asia, because of China, even though right now the market has gone down a lot, if you add mainland China, Hong Kong, Macau, and even Taiwan all together, we are still talking about more than 50% of the universe, right? So therefore, if you invest in Asia, there's no way you can skip China, because if you skip China, you are missing a big part of the investment universe. And also in terms of the sector, I think in terms of sector actually quite similar. In a way that financial accounts for the biggest portion. Okay, the Asian universe has proportionally more real estate compared to the Western market. Even though we're talking about after the collapse of China property sector, we're still talking about 15% is in real estate.
Okay.
But only a small portion in China. The real estate predominantly is coming from Hong Kong, some from Indonesia and other Southeast Asia market as well. I would say the sector exposure is reasonably diversified. It's just that for Asia, you have to look at China.
Yeah. Is another interesting dynamic, and this is probably a characteristic that's shared with the equities market. There is at the very least, a perceived risk premium investing in Asia, right? So if you over the last 2 decades or so, has there been a risk premium in Asian credit, whether it be investment grade or high yield? So for our audience's benefit, investment grade debt is debt that's rated BBB or above by Moody's, S&P or Fitch, and anything lower than BBB is what we call high yield. If you're buying the equivalent investment grade or high yield security in Asia, is there a risk premium that, whether it be perceived or otherwise, is it there, and therefore is that an investment opportunity to capitalize on, you think?
Yeah, the so-called risk premium, or the difference between the yield of the Asian issuer versus that of the developed market, namely the US, right? That so-called yield premium or risk premium always exists. It's just a matter that sometimes it's larger, sometimes it's lower. Okay, there are times in history that the Asian premium, the yield premium, actually turns negative, meaning in terms of yield, Asian credit has become more expensive than the US. That's when the Asian economy has performed proportionally much better than that of the US. Now, there was some point. So I attach that Asian premium. Part of the reason is because of unfamiliarity from the issuer, because for a lot of Western investors, Asian investment is new to them, right? So just geographically, they are not sitting in this part of the world, and naturally, they have less understanding of the fundamentals. So that Asian credit has always been excess, okay? But in general, in a normal market, that yield difference or the yield premium from Asian issuer will actually help Asian credits to outperform US, because you are talking about if nothing's happened. Let's say you buy a bond today and nothing happened, the world freezes. And let's say 1 year later, you will capture that yield premium, and that's an additional return for investor.
Okay.
But the key is it's better to entrust the money into a manager who knows the market.
Yep.
And who knows what name to pick and what bonds to pick.
Okay. If you then, you've been a credit guy your whole career. The last 6 or 7 years, there's been a big gorilla in the tent that is growing ever bigger, that's competing with you, called private credit, right? In Australia here, the private credit market has effectively gone from zero to about, I think, $100 billion in the matter of 6 or 7 years. And that is, going back to the fact that the Australian banks, the large banks, have had very significant pressure put on them by the regulator to shore up tier 1 capital and so on and so forth. To the extent that, we recently discussed that APRA has come out with a paper saying that they want to basically stop AT1 or hybrid securities in Australia. Again, going back to that very conservative nature with regards to, ensuring stability in Australian banks. How big of a threat do you think private credit is to you as a public credit investor when chasing for investors and capital?
That's a very good question, Jonathan. I think we shouldn't look at private market and the public market as two separate markets. In fact, I expect the private market and the public market will sort of become more alike, meaning these two, the boundary between these two markets will, over time, will get more murky.
Why is that?
Because, private credit, public credit, they are still credit, right? It's just that, each market has its own merit, right? And for example, the private market, the transaction is usually quite bespoke. It can tailor make to any size, any terms and condition, any security attached to it. So it's highly customized according to the issuer as well as investor alike. So, and also it can do in any sizes, right? And usually the public bond, you have to do certain sizes, right? But however, for private credit, I would say you are exchanging liquidity with additional return. Because private credit, by definition, those are private. They are not liquidly and widely traded. Although there's a secondary market, but there's usually trade by appointment, right? So there's usually not a readily available public market for private credit that you can actually, get in and out easily. But on the other hand, the public market, the bond formats are usually quite standard, right? Across issuer, across country, across all the bond. So, and therefore is very liquid, and you can trade, even 200K in terms of size, so big and small. So arguably, they are much more liquid. So it really depends on the investor appetite, where their liquidity requirement, whether they are willing to trade liquidity needs in exchange for additional return, and whether they want additional security coming from the private market. So I would say, although right now these two markets started off quite differently, separately, but I think over time, the boundary between these two markets should become less and less obvious. Ultimately, they are just credit instrument for issuer to raise funds.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
It's sort of interesting, as you rightly pointed out, in private debt there is that lack of liquidity. And speaking to some of our own clients, they have gravitated towards private credit a lot in recent years because they don't see mark-to-market volatility.
Right.
So they think it is a linear path to returns.
Okay.
No risk.
Right.
Okay. Whereas in the public markets, risk is reflected on a second by second basis, right, on the trading side. Is it therefore private credit is a little bit smoke and mirrors then?
Okay, well, the mark to market is very unique for public market, right? So for private transaction, you can argue, let's say you buy a bond, buy a private transaction at 100, you don't mark it. You don't mark it because there's nothing happen in the underlying transaction. That's why on paper you will see a very, very stable price every day. But that stable price only hold when nothing's happened, right? So if something happened to the underlying investment of the private credit, you will instantly see a mark up or mark down. It's a step function. It's not a continuous function, it's a step function. So I think for a lot of private credit, it creates an image that the market is very stable. It is stable as long as there's nothing happen, no credit event happen in the underlying transaction. But if there's a credit event, then the investor in this case is actually hurt doubly because first of all, you have a big drop in mark-to-market price. And then secondly is that, that's probably the time when some of the holder want to sell the bond.
Yes.
And then all of a sudden you have a flush of supply that nobody can place to anywhere. And that will actually will exaggerate the downward movement of private transaction. So again, going back to my previous answer to you, okay, investor investing in private transaction, of course they need to understand the credit fundamental, what sort of downside protection they have in terms of security package. But also most importantly is to assess your own liquidity need versus the profile, the liquidity profile of the private transaction.
Fair enough. Going back to Asian credit markets, let's talk about a recent sort of theme that's been in the portfolio for probably the last 2 years. And the thesis has evolved, which is why I want to unpack it, because I think it's quite interesting. This is Macau. So, you started looking into Macau, I think around 22. This is before lockdowns ended in China, right? And therefore there was also no flow of tourists and, people that wanted to be involved in gaming, in the back end of COVID. We still hold Macau positions today, but for a very different reason. Can you talk us through how that theme has evolved from an investment perspective?
Yeah. The Macau gaming universe has always in our universe. It's just that for the longest time we haven't owned a lot because we think the valuation of this entire sector is not very attractive. Okay, when COVID hit and China becomes locking down their entire country, including Macau. Something that used to trade around in terms of yield 5 to 6% yield, all of a sudden they give you double-digit yield. Okay, so at that point we look at all the sector. Actually, inside that Macau gaming sector, a lot of them they are household name. Right, for example, Sands, MGM, and also Wynn. Right, these are like big global player in the gaming industry. Now you have to ask yourself, would the lockdown become a perpetual event? The answer obviously is no. Okay, just at that point, we believe that the Chinese economy will eventually open, although we don't know the exact timing. But all we know is that at double-digit yield for global player with enough liquidity on their balance sheet, even though even their casinos shut down, for a considerable amount of time, a lot of the issue in that space can still honor their payment of debt obligation. It's just that the sentiment back then was so bad that nobody's want to touch it, and that's why we see an opportunity to basically buy Macau gaming. Basically, virtually going from we own nothing in Macau to around at the peak, probably around 15% of the portfolio, right? It's all in double digit. And then eventually China, we eventually reopen, and then the normalization happens. So all the way from then on, yields collapse from double digit to all the way to, I would say, a more normalized level around 6 to 7%.
Yep.
We still like Macau at this point because, first of all, when China property sector is gone, there's not much other sector people can invest their money. So that's become another sort of relatively safe place to park money. And in addition, as I mentioned, a lot of these are global names and Western investor, like manager in London and US, because these are the names they know, right? So, and actually, these are quite favorable among Western investors. So it provides another level of technical support of this sector. So we continue to like Macau, not because of the spread compression, but because of on a 6 to 7% yield is a good carry play to us.
That's good to know. To sort of finish off, I want to talk about something slightly different, which is I think it'll be very helpful for our listeners of this podcast in relation to, it's sort of a bit of a cultural question and talks about Hong Kong and Hong Kong's future. We don't get a whole lot of news flow in Australia about China broadly. Generally, it's been quite negative, right? Taiwan will be invaded is usually the headline that we see. And it's usually, the US takes a stab at China and that gets, noticed by Australian press, but not a lot of positive news come out to here. And as a subset to that, even less about Hong Kong. One of the challenges, I guess, Hong Kong, if I think about, when I was growing up, as a very simple anecdote, is when I grew up and, you go to Hong Kong, you go to the mainland of China, they're more than happy to take Hong Kong dollar as equivalent, like a one-to-one basis, right? Nowadays, they completely ignore, right? Because the Chinese RMB is worth a lot more than Hong Kong dollar. And sort of in the same instance, the standard of living that Hong Kong people have sustained over many decades is very high. Like it's Western standard of living, and Western standard also levels of income, right? And also very, very favorable tax environment. Recently, including yourself, and you've shared stories with me, that just going north of the border through high-speed trains and things like that, going to Shenzhen or Guangzhou, great places to visit. It's a fraction of the cost. And because of what happened during COVID in Hong Kong, a lot of people also left Hong Kong. Now, going forward, Hong Kong is still a critical city to China. How do you see the future of Hong Kong play out with such a huge discrepancy in living standards, income standards? And is it still, in your belief, being a person that's lived there for most of their life, still going to be a critical financial center?
Well, if you look at Hong Kong, the standard of living, as you mentioned, has been very high. And predominantly because of the property price has been quite high, right? Right now, if you compare the general property level in Hong Kong, probably we are down around 30% from the peak, right? But don't forget, for the past decade or so, it's been up, right?
So even X time,
right? So even though we are talking about down from 30% from the peak, on a relative basis, Hong Kong by far is still expensive. It's just less expensive than before. However, I do believe that, as I mentioned, property price is very important to the society. The associated negative impact from the collapse of the property sector, people, you don't want to imagine what will happen, right? So I think the ultimate is that, well, although there might be still downward pressure on the Hong Kong property price, therefore living level, but I think the majority of the change we should see is that a catching up in the Shenzhen area, sort of in the price level from Shenzhen will keep going up. Hong Kong will still be down a bit, but slowly, but Shenzhen will catching up really fast. Especially, you're talking about, a lot of Hong Kong people likes to go north in Shenzhen to spend, right?
Yes.
And that basically create a lot of demand for their goods and services, right? So that my thinking that Shenzhen will actually price level will go on up. Eventually, these two will converge to a more reasonable level. But still, I think on the stable level, Hong Kong will still be slightly more expensive than Shenzhen, simply because of the international nature of Hong Kong. Right? Hong Kong is a free market.
Yep.
Capital can go in and out. And I believe these kind of good features, plus the low tax, these kind of features should command a premium, whether it's talking about property price or asset prices.
Do you think, and I sort of allude a parallel to sort of developed Europe, right? Developed Europe has also enjoyed very significantly high standard of living for a century, all right, or plus. And if you think about the 2010, 2012 European debt crisis, that whole concept of pulling the purse strings and be willing to reduce debt, right, was not a favorable policy choice, and therefore a natural lowering of living standards if you want to go through attrition through that way, right? So if I draw that parallel to Hong Kong, do you think it is possible for the Hong Kong population to accept a lower standard of living going forward, comparable to what's offered in the mainland? Because that's a challenge psychologically, right? It
is a challenge, but I think for Hong Kong, we need to distinguish ourselves in terms of the level and quality of the service. If you talk about par-to-par quality, of course, Shenzhen will have much more advantage than Hong Kong. But Hong Kong will have its own uniqueness. Just like Switzerland is very expensive, but people still go. So Hong Kong need to provide some uniqueness in terms of the quality of service, availability of goods and services, and also the freedom going in and out, plus the low taxes, and all that will add up to Hong Kong should command a premium.
Fantastic. Well, Gordon, thank you very much for sharing insights. We talked about a range of topics today, from the Asian credit markets to China's post-COVID recovery, where the property market is, as well as we touched on what's the future of Hong Kong. Hopefully you enjoy the rest of your week in Australia, and wish you all the best.
Thank you.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.